We are seeing global growth forecasts improving as vaccinations worldwide are taking closer to that 500 million mark. Which regions do you see leading the pack in this recovery? But what areas perhaps are still at risk of a recession in the near term this year?
Well, I think in terms of the vaccinations, the major countries that are way ahead are the U.S. and the U.K. In terms of the countries that are at some risk, we would look at where COVID is picking up sharply. COVID is picking up again in the Eurozone, and COVID is picking up in South America, parts of Latin America, Brazil, Chile are some places that we're concerned about right now. We're not really looking at recession risk in many countries because growth fell so much last year. It's very easy to normalize somewhat this year, but the growth outlook is very different across countries nonetheless.
Now, we're still getting some mixed data from the U.S. For example, durable goods numbers fell for the first time since April. Some of that may come down to the global chip crunch that we're seeing and how that may impact supply-demand risks. What's your takeaway from this?
That's right. I mean, supply chain problems are very serious at the moment, and we're seeing that in prices, we're seeing that in inventory data, and that can affect some of the investment and durable goods data like we saw today. But on the whole, I think the tailwinds are substantial for global industrial production and global trade right now. I think consumer spending globally is going to be boosted in the short term by the U.S. stimulus, and I think we are a few months away from a liftoff in the tradable sector, the services sector, excuse me, in the U.S. When vaccinations get to that critical threshold that allows social distancing to fall.
So on that, would this sway your prediction for 2 rate hikes in the U.S. by the end of 2023?
Well, we have to pay attention to what the Fed is saying. So our forecast of 2 by the end of 23 is actually more aggressive than what they're saying. They seem that their dot plot seems to suggest no hikes until 2024. The market is a little bit ahead of us, expecting more than 2 by the end of 2023. I think that's reasonable. But I actually think this bunch at the Fed is pretty committed to allow inflation to overshoot and to lag this recovery. So we're pretty happy with our forecast of 2 hikes right now.
And of course, aside from inflation, employment very much key. Yellen saying she's aiming for a near full employment next year. What's the trajectory that you're observing?
Well, down in unemployment. We think jobs growth is going to be gigantic once that in-person services sector starts coming back to life, which we're hopeful can happen this summer because we think vaccinations in the U.S. will be sufficient to allow people to really end their distancing and start taking their vacations. At that point, there's going to be a lot of hiring needed. The Fed themselves are forecasting 4.5% unemployment by the end of this year. I think that's a reasonable forecast. And then as stimulus continues to drive the economy beyond that, it should continue to fall. So we're looking at some very strong growth. Full employment, of course, is a contentious topic. Where is it exactly? But I think we're going to be in the neighborhood of that 4% unemployment rate, which we saw before the pandemic, by the first half of next year.
Now, the Fed decided last week to end SLR exemptions at the end of the month while signaling that adjustments will be forthcoming. Does this signal to you that tapering may be on the way?
No, it doesn't. I think this was a technical change. I think these exemptions were an emergency measure during the pandemic, and some internal work that we've done with my colleague Zoltan Pozar suggested it was not necessary to continue these exemptions, and so they haven't. There's some other tweaks that the Fed can do, but it doesn't really inform us about tapering. I think 3, 6, 9 months from now, if inflation is still running significantly above 2%, which we think it will get to by June, then the Fed may consider reducing its asset purchases, first signaling an intention to reduce their asset purchases, and they're not even there yet. So it's going to be a little while, and this news does not tell us about that.
Now, we are seeing a reprieve in bond markets from treasuries to bonds this week. Will that be short-lived? What levels are you watching when it comes to U.S. yields?
Yeah, well, I mean, I think a 2% 10-year yield is a reasonable forecast for the end of the year, but we have had a sharp move already, and I think with COVID infections picking up, with growth outside the U.S. looking troubled in some ways, we're not looking for an imminent explosive further move higher in yields. And in recent days, we have seen a little bit of a risk-off tone in some financial markets.
Now, James, if you could put on your other hat now, regional CIO for the Americas International Wealth Management business, what are the biggest concerns that are being raised by your clients?
Well, it actually depends on where the clients are, but clients outside the U.S. talk a lot about the debt levels in the U.S., the future of the dollar, and whether all this stimulus is sustainable. In the U.S., those aren't major concerns. There's a broad belief that this level of borrowing can be dealt with. So, from our perspective on the investment committee, we're maintaining a moderately risk-on portfolio. We were more risk-on months ago, but we're underweight government bonds, and we're overweight certain risky assets, including commodities at the moment.